excited to be doing this, have this seminar today. I want to thank ICE for co-sponsoring it and helping us set it up. Quickly want to introduce our speakers. Ray McKenzie, who's a rock star, as I like to think of Ray. He is Vice President Market Development for ICE Futures US. He oversees all their business development and marketing for ICE US future product lines across agriculture, equity index, and foreign exchange. He spent 13 years as managing director at Morgan Stanley and 4 years at the CME, where I actually first met Ray. I don't know how many years ago that was. In addition to Ray, we've also got Ken Shaleen, who is the president of Chartwatch. Ken has founded Chartwatch in 1984. He's done a number of presentations for us, so we really want to thank him for coming back today. He's the author of Volume and Open Interest, does technical analysis and option strategies, as well as 3 CME course books on technical analysis. So what I want to urge everyone to do is ask questions as they come up and make this as much of a dialogue as possible. So with that, I'm going to turn it over to Ray. Thanks, Ken.
Thanks, everybody. Before we start, I want to ask, what kind of an audience do we have here? How many are traders? Almost all of you, that's great. Have any of you ever traded dollar index before? One or two? That's good. We're going to teach you how to trade it today and talk about why you should trade it. So let's just get right into it. So the dollar index, if you watch television, most days you'll see on CNBC or Bloomberg or any of the business news programs, they'll talk about the DXY. Have you seen that? And Rick Santelli from the floor will talk about the DXY, is the dollar index is doing this or that, the other thing. It is the most widely recognized currency benchmark in the world today. And it's been around for about 30 years. The dollar index was actually created by the government in 72, I think, something like that. And essentially, it was initially about 20 currencies or so, because there was a lot more European currencies at the time before the euro. So in 1999, the government changed the makeup of the index, which I'll show you some more details in a second. And it hasn't changed since then. So since 1999, it's been the same index, and that's what everybody's talking about every day. So when you see the DXY on the screen, the only place in the world that has a futures contract on the DXY is ICE, not CME. CME just launched their own recently, but ours is the only one that is benchmarked to the DXY. And so what's happened is we've gotten a lot more people in the last year talking to us about, the DXY, trading it from all walks of life, from either retail traders, asset managers, institutional traders, banks, hedge funds, CTAs. They've really come in the last year, and you can see this chart's a little bit lopsided, but you can see that the growth has been tremendous. Last year at this time we were doing about 3,000 contracts a day. Now we're doing about 30,000 contracts most days. We hit 77,000 contracts in a single day a few months back. So we anticipate the growth to continue. The liquidity is great. Anyone who goes in there and trades, it really seems to like the liquidity. Here's a little bit about our trading hours. ICE is a little bit different than CME in terms of our trading hours. We do trade 24 hours, 1 day a week. We trade Sunday night, 6 p.m. Eastern Open to 6 p.m. the next night, Eastern time. So there's 1 day a week that we trade 24 hours, Sunday to Monday. We take a 2-hour break every night from 6 to 8 p.m. Eastern. We open at 8 p.m. So our hours are a little bit different than the CME in that respect. So those are the hours for all of our financial products, okay? It is traded exactly like the currencies at the CME, same delivery date, same expiration dates, all that kind of stuff. Quarterly contracts, so March, June, Sep, Dece. There are no daily price limits. It's a $5 tick, and most of the time, it's a half a tick market all day long. So it's 75 and a half to 76, things like that. Let's see, the overnight margin is $1,400. That's since September 9th. It changes a lot. The currencies that are in the index, Euro, Yen, British Pound, Canadian Dollar, Swedish Krona, and Swiss Franc. And everybody always goes, why Swedish Krona? Well, at the time the index was created, the Swedish had a pretty good exposure in world currency trading in terms of international trade. And as I said, since the euro came into the index, all those other small European countries merged into that. And so they kept the Swedish the way it is because the Swedish is not in the euro. We also have options. I'll be honest with you, don't trade very much. They do trade on the floor a little bit. We launched them electronically a while ago. We're trying to build the market. But we're really here today to talk about futures. So we do have the options for those if you need it. Price information, we have real-time quotes on our website, so you can actually, if you don't want to subscribe to the market data, even though the market data is free, you can go on our website and look at real-time quotes on the dollar index and the Russell. We have free real-time prices, free real-time tick data going back a certain period of time if you need that. And if you do any kind of algorithmic trading or do any kind of modeling, that's very helpful. And then we offer a free financial package to all of our data vendors right now. So the dollar index, Russell, and our currency pairs are free on all vendors. So if you have a front end that doesn't have it, call your vendor and say, hey, I know it's free. You shouldn't charge me for it. For more information, you can just contact Well, you can contact me, ray.mckenzie@theice.com, or you can go on our website and there's more info at theice.com there. And the real guest today is Ken Shaleen. And just a little bit about Ken. I mean, he really needs no introduction. He's been around for many years. He's an industry veteran, very respected by everybody. I met Ken in 1979 when he was a runner on the old Merck, which is now what's the gym, fitness club, whatever. But upstairs, I don't know if you remember this, Ken, they used to teach in the old visitors gallery at the old Merck. And they'd have classes up there. And Ken came and did a technical analysis course, and it blew me away. It was fantastic, and I used it ever since I was a trader. So Ken's a good man. So Ken, do you have slides that you want me to pull up here, or are you just going to go right from that?
I'm going to use the old-fashioned overhead transparency.
All right, great. I got slides here. I need to pull them up, but anyway, Ken Shaleen. Yeah, turn on.
Okay. Do we need a microphone? You want me to put the mic on? That's okay.
No, we're okay.
All right. Everybody hear me okay? If you can't, just raise your hand. Let me know. Here's what we're going to do. I'm a classical bar charts and heavily into volume and open interest. So we're not going to talk about Fibonacci numbers or crossovers or moving averages. We're just going to beat on the charts. We're going to go from the monthly chart to the weekly chart to the daily chart to the hourly chart. And we're going to look at volume and open interest on the daily chart. We're going to look at support and resistance, and we're going to look at some price patterns. Don't take off, because there's an active price pattern on the daily chart of the Geese dollar index, and there's an active price pattern on the hourly chart. Okay, well, first of all, let's look at the monthly chart. Now, futures traders, and actually probably even buy and hold type traders, really aren't going to even look at a monthly chart. This is just to give us a very, very long-term picture. This is way too long a time frame for a futures trader. I guess while I'm on that subject, as a trader, the first thing you have to determine is what time frame are you going to be dealing in. I'm not talking about time zone in the world, I'm talking time frame. Are you going to be a longer term, buy and hold, sell and hold position trader? Are you going to be a short-term trader in and out and be holding for a couple of days? Or are you going to be a day trader? Those are all three very different time frames. And what you want to do is pick your technical tools that are best suited for that time frame. Because if you try to trade in two time frames at the same time, if you try to be a day trader and you try to be a position trader in the same product, more than likely you're going to screw up one or the other, or probably both of those time frames. It's better to say, look, I'm not going to begrudge the other time frame trader his or her profits. I've got my blinders on, and I'm looking at this time frame only. Sure, what you want to do as a trader, though, you want to look one time frame lower. You want to massage your position up when you put it on or take it off, and you want to look at one time frame higher just to get the longer term picture. But you're going to have one time frame, and for me it's the daily high-low bar chart. That it's my main chart that I look at, and that's because it lends itself to the analysis of volume and open interest. You do not look at volume on less than a daily chart or greater than a daily chart. And there's no such thing as open interest changes intraday, so forget about that on less than a daily chart. And on the weekly or the monthly charts, I don't think the changes in open interest are as important. So why I'm even putting this up? And this is the spot. We're going to start off with the spot just because I want continuity. We're looking back this far. Then we're going to look at the nearest future dollar index, then the dollar index hourly.
Can I say something about the spot, just so you know how the spot is calculated? Reuters calculates that they take the last 6 bids in 6 currencies, and they do a geometric calculation that the Fed created. So when he's talking about the cash index, it's not a tradable index. They're just taking the last 6 bids of those currencies, and they do the calculation. They publish that, I think, every 2 or 3 seconds. But you can't trade it.
Like when you're trading this dollar index future with this pair of 6 currencies, so
Yeah.
like what kind of weightage you give to different currencies?
Yeah, I didn't say the weighting up there. It is on our website. About 56% euro, and then it drops off pretty dramatically to like 20%. I think the yen is the next biggest, then the pound, Canada, Swiss, and then the Swedish. Okay, but it's on our website. But it's small percentages of euro. Euro's the
So how
biggest.
you calculate the price of this? Like, there must be, since the underlying is the 6 currencies.
Yeah.
How you calculate the price? Is it just the weightage?
It's a very complicated formula that you guys can create. It's a geometric formula, and we have it on our website. We can show it to you, but it's pretty complicated.
Okay, the reason why I wanted to show you this is take a look at our old friend, if you're a classical bar chartist, the head and shoulders formation. Back when the euro was first created and it started trading, there was a head and shoulders top on the dollar index. And just to kind of refresh your memory, if you're not used to this, you would go from the extreme of the head down to the neckline. You would take that distance, and I take my low-tech dividers here and move it over to where the neckline is broken. That gives you the downside measuring objective. That's this classical high-low close bar chart. So you can see this vertical target was met. Now, why do I want to point that out? There are some traders who are saying, well, could this be, and we have to reverse this in terms of the head and shoulders bottom, where the low on the chart would be the low of the head. Could this be the low of the head in a multi-year developing head and shoulders bottom? Well, the answer is yes, but it could be is the operational word. We're not going to trade on this right now, but here is the neckline. If we should get a monthly close on this spot index above, let's round it off to 88.70, it would activate a huge multi-year head and shoulders bottom. Now, don't get too excited about this yet, because here's what the bears are going to say. They're going to say, well, look, that's reversal of minor trend. So is this. So is this point, and so is 88.71. They will have a line in here, and they're going to say, well, that pattern that's trying to form is a symmetrical triangle as a bearish continuation pattern. So what we can say for sure here is that something big is going to happen, but probably not right away, because we are coiling in here. We're getting tighter in this range, and once it comes out, it's going to go either this distance to the upside or from 89.62 down to this line, that distance to the downside. So we've got something to look forward to in the, it might be months, it could be 5 or 6 months before that happens. But anyway, it's an interesting chart. We just can't do anything with it right now. So let's drop down to the daily. Excuse me, the weekly chart is next. Now what I've used is the nearest future. Now you have to be careful sometimes with using these nearest futures charts, because it depends on your charting package algorithm and how they pick and when they pick up the expiration. They go to the bitter end, and on the very next day they start plotting the price of the next active future. It's indicate what I'm getting at. You see what I'm getting at. There could be a discontinuity on the weekly chart because of when the nearby drops off and the other one starts up. So we're not, as active traders, we're really not pulling the trigger based upon the weekly chart. We're trying to get an idea of the longer term. And this dashed line that I have up here, and that's the convention that us technicians use for a neckline. That's the neckline. You can see that I've indicated it here, that I had on the monthly chart. All we can see right now is the possible left shoulder. So what's happening on the weekly chart? Actually, not much. We've got this.
Is that a possible cup with a handle that O'Neill uses?
I'm not an aficionado of the cup and handle formation. It's not because I don't like it. It's just that what I use is, as my Bible, is Edwards and McGee. Technical Analysis of Stock Trends by Edwards and McGee. And cup and handle formation is not in that particular book. But you brought up a real good question. For those of you who are just getting started in your technical analysis, there's 2 books that you're going to want to have. If you like this stuff about classical bar charting, it's going to be the Edwards and McGee book, Technical Analysis of Stock Trends by Edwards and McGee. Now notice the word stock. In the old version, the 5th version, there is a chapter on futures, but it's really no good. But if you want to learn about price pattern recognition, it's Technical Analysis of Stock Trends by Edwards and McGee. In that book, there's nothing about the newer types of technical analysis, RSIs, stochastics, crossovers and moving averages. So the John Murphy book is the other one that you get. It's called Technical Analysis of the Futures Market by John Murphy. Those are the 2, cornerstones in terms of the books. Okay, well, what is this low here? Why did I indicate the August 16th low on the nearby future? It's simply a benchmark low. It is not underlying support. So we shouldn't expect that it's going to stop there. As a matter of fact, some of the bears will have this line in there and say, if we were to close below Friday close on the nearby future, below this August 6th low, we might activate something that actually looks like a head and shoulders top on the chart. We are going to talk about support and resistance in a little bit. If we were to get down below 80.17, that would now be overhead resistance, and the charters would want to be shorting rallies against that overhead resistance. But right now, there's not too much going on the weekly chart. But when we get to the daily chart, here's where it gets interesting. This is the December future. It has yesterday's price activity on it, and because the volume and open interest, and we'll talk a little bit more about this, it's always a delayed statistic. The end-of-day data that I get from the CRB charting service, they give me that 1-day delay, because that's when the exchange comes out with it. So these bars and the line for the open interest, 1-day delay. This is through Tuesday. That's always the way it's going to be. Now here's where this gets interesting. Here's where we can actually do something. Look at this. Left shoulder, head, right shoulder. We've got an active head and shoulders top on this chart right now. What's the downside measuring objective? We're going to go from the high of the head, which on the DX future was 83.96. We're going to take that vertical distance, and I figured it out mathematically as well. Because we're using an arithmetic scale for price, then the arithmetic and the graphic objective is going to be the same. Meaning you take this distance and you move it over to where prices broke to the downside. Those 2 distances are equal. The classic downside measuring objective based upon this height is 80.57. Now, there's a small problem with that objective, and that is if you go back to basics, you read that Edwards and McGee book, in there, in the fine print someplace, it says that any reversal formation, like a head and shoulders formation, cannot be expected to retrace more than the move that preceded it. That's why if you have a head and shoulders top, it has to be on the top of something. You have to have something to correct to the downside. So let's ask the question, where did the price up move before this head and shoulders top appeared on the chart? Where did that start? You see where it started? It started at that low, 80.74 and a half. So actually the objective really, since 57's below 74 and a half, I really shouldn't take that. I should say this is the objective. We're going to attack this low at 80.74 and a half. Now, it wouldn't surprise me though to see this, because this is just a benchmark low. It's not underlying support on the chart. We should not be have any preconceived notion that the market's got to stop at 80.75 here. Yeah, it might slow down there, But think about it, if every low on a chart was gonna be support, how can you ever get a bear market? So we may come down there and waffle around a little bit, but once we close below 87.4.5, then it's gonna be overhead resistance. And I'll come back and reinforce that concept in a little bit. Okay, staying with this chart, look what we had yesterday. That was Wednesday. We had an inside range day. An inside range day is one of the 4 minor trend change indicators. Now this is where if you're a day trader and you want to get your marching orders of what to do next, you want to look for the 4 minor trend change indicators, which are the key reversal, the outside range, the inside range, which is what this is, or a mid-range close. Now we're going to see if this has worked or not when I show you an updated chart. But in theory, it should have indicated that we try to kick back a little bit to the upside. The theory behind any of the minor trend change indicators is that whoever was in control going into that trading session has now been neutralized, and the other side is going to take over, if only temporarily. Well, the bears were in control, but the bears couldn't get us lower than Tuesday's low. The bulls haven't taken over yet. They couldn't get us higher than Tuesday's high. So that teeter-totter seesaw is in neutral, and you would think that we're going to try to pop to the upside. Okay, now be careful. You know by looking at this chart that the trend is down because you've got an active pattern. And now you see a minor trend change indicator that's calling for a possibility of a rally. Can you see that we've got 2 different time horizons going on right now? We've got a bearish trend and possibly a little bit of a rally. If you wanted to buy this thing as an aggressive short-term trader, you have to know that you're trading against the direction of the trend. So if this fails, it doesn't make a higher high and instead makes a lower low, you're going to be stuck with a loss. The trend is always stronger than most of these minor trend change indicators. So be very careful. I would really, if I was a position trader, meaning have the ability to hold, and even if you're a day trader, you want to have enough money in your account. You don't overtrade, but so that you can hold the position overnight. Because sometimes there's a situation where you want to try to follow that old adage of letting your profits run. And I would have really wanted to sell a rally against overhead resistance. Well, where's the overhead resistance? It's at this low, 82.33.5, and then 82.39. So the daily chart is clearly bearish. There might be an attempt today to rally. Now we're going to look at the hourly chart to see whether that attempt happened or not. But before we do that, we're now going to talk about what's going on here at the bottom of the chart. This is total open interest and total volume. Now, most of these electronically traded contracts on the various exchanges of the world and the dollar index as well, all open interest is bunched in a nearby contract. But, and I don't want to talk about any of the other exchanges, but if you have something where there is open interest going on out to oblivion, like maybe something like a euro-dollar time deposit futures, you want to take total. It's a summation of we're going to have a minor problem with our analysis here. If you pay attention to what I'm going to go through next, we're going to be ahead of 80% of all traders or dealers worldwide, because we're going to try to analyze price change versus open interest change. And the reason why it's going to be difficult is because the SEP DX future just went off the board. But we're going to take a look at this. So it's total. Now, what I'm going to show you next is a slide that I've used for as many years as I've been teaching. This is the general rule for a healthy price trend on any futures chart. Now you have some of these handouts, some of these are in your overhead. Some of the overheads are in your handout. But anyway, let me read this to you. It says that both volume and open interest should increase as prices move in the direction of the major price trend. Therefore, the most bullish situation you can find on a futures chart is price going up and the volume bars going up, meaning volume is increasing. And at the same time, the number of open contracts. Now, hopefully I don't have to reinvent the wheel, but I think you all realize that open interest is the summation of all unclosed purchases or sales at the end of a trading session. And the long open interest always has to equal the short open interest. There can't be more longs at the end of the day than there are shorts. It always has to to equal. So you'd like the open interest to be increased. Well, we all realize the price doesn't go up every single dealing session. From time to time, even in a long-term bull market, there's going to be adverse moves against the direction of the major price trend. So what you would expect to happen is, if there's no urgency created in the marketplace, because volume is a measure of urgency, is the volume would come down. This is the proverbial low volume sell-off. And a low volume sell-off for a technician is bullish. It's telling the technician that the direction of the trend is still, in this case, up. And it wouldn't be surprising to see some profit taking by the longs, getting out, and so the open interest would go down. Prices start going back up again. What you want to see is increasing volume and increasing open interest. So every morning, what you're going to do is pounce. If you're a day trader, this is still important to look at this, to get an idea of the health of the previous day's move. You are going to go to the ICE website and pounce on those statistics as they come out. And there's about 4 different pages that you can go to. And I'll show you what I've been doing in terms of this presentation. You can ask Ray what's out there as well. So this is what you like to see, obviously, if you're a bull. The ideal healthy bear market. Now, this is not as easy a situation to find, especially in the physical commodities. I don't put the dollar index in the physical commodity category, but the quote-unquote commodities that the public likes to trade from the long side. Let's say it's coffee, cocoa, sugar, orange juice. The public, outside public, likes to be a bull. They like to buy stuff that's going up. They don't like to sell stuff that's going down. But if you can find it, price down, increasing volume, increasing open interest. See, that follows this rule. See, if the major trend is down, you want to see the increase in the volume and increase in open interest on the price down days. And I always have to talk about this because this is one of my pet peeves. You've all heard this before. Short covering rally. Okay? Now, the reporter that talked about it being a short covering rally, you see it on either on a computer or a newspaper. How does the reporter that wrote that story know it was a short covering rally? Well, in our old open outcry environment, I suppose if you talk to a trader and they could see fear in the eyes of the biggest buyer that day, then maybe they could deduce it was short cover. But these order fillers, they just have a fiduciary responsibility to do whatever it says on that piece of paper. It says buy 500 at the market. That's not theirs. They're just executing. So that trader is making an educated guess. Now, most of these guys are pretty savvy, but the clearing member firms did their best to shuffle around business so that the locals on the floor wouldn't know who was doing what to who. So the answer is the trader was making an educated guess. Now, how, if we have open interest statistics, are we going to know that it was price up, but it was short covered? What would the open interest change be? The delta in open interest? Okay, open interest down. Yeah, I agree. Okay, when the reporter was writing that story, just typically just after the market closed, was this change in open interest figure available? No, there's a delay in that statistic. So, how should the story have been written? And once you hear this, you'll kind of smile every time you see this. Here's how the story should have been written. Trader stated that today's price rally was apparently due to net short covering. This will become known with certainty once the open interest figures are available. If indeed open interest went down, then today's rally was due to net short covering. Do you ever read any of that extra verbiage? No. So just smile and say to yourself, I'll be able to confirm it, but not until those figures come out. So you want to pounce on those as early as you can in the morning. And ICE does have preliminary open interest figures, and Ray told me.
So I was just talking to Ted. So Ted works in our group too, Ted. So around 4 a.m. we release preliminary, and then the final is about 8:30. And CME releases a preliminary at the end of most days, and most people think that's a final, but it really isn't a final. Their final comes out about the same time as ours at 8:30 next day.
Right. Now I don't want to put you on the spot, but have you noticed any dramatic changes between the preliminary and the final?
It's been pretty close, right, Ted?
Very close.
Yeah.
What's mainly important is that the sign does not change from a positive to a negative open interest change. That just puts the killer into your analysis. And I'll tell you, let me pick on somebody. This is the absolute worst in terms of preliminary volume open interest figures. Do not even make an attempt to do it. And that's on the gold and the silver futures. The CME website gets it wrong by magnitude and direction so often. It's just horrible. You don't even want to go there at all. So anyway, we want to know whether it was a short-covering rally, because, and why, we haven't talked about this, but you all realize, is a short-covering rally in the long-term scheme of things bullish or bearish? In the long-term scheme of things, is a short-term rally in price that's due to short covering, is that long-term bullish or bearish?
Bearish.
It's bearish. There's an old adage down on the open outcry trading floors that it's still great, and that is, watch my palms. You know, if my palms are facing toward me, it means I'm buying. And I actually still have an option seat over on the board of trade, but I'm leasing it out right now. Look, the buying is all done by the shorts that are covering. Buy, 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 buy. Now, what happens when the last week's short is finished buying? Watch what's going to happen to my palms. There's no more buying. You know, somebody goes, sold, boom, sell, boom, down it goes. So a short covering rally is full of sound and fury, but signifying nothing in terms of long-term bullish. And then ideally, if the market starts coming down, you'd like to see the volume increase and the open interest increase. Okay, so beat that into it. Now let's do some volume analysis. Now you are not going to have this in your handouts. You're just going to have to look at mine. What I did is I got the nearest future here in the DX, and I've squashed the open interest figure up near the top. I squashed the price way down. Why? Because I want to make the volume bars as big as possible. And hit the print button and print it out. And then you want to go back an appropriate distance to start your analysis, and you want to draw horizontal lines that are giving you an idea of what constitutes low, average, and high volume. And I would go back to basically the expiration of the June contract, because these volumes in here are going to be, as far as I'm concerned, are too high. We want to pick figures that are representative of what's going on now, of what's happening next. And I did this very carefully, and here's what I came up with. Let's put in a line at 15,000 contracts. Right there. That's at 15,000 total, and here's 22,500. 22,500. What you do to see whether those values are representative or not is over this period, you count how many readings fell in each of the three categories, and they should be about equal. And if there's more in the low volume territory, it's okay. So I go 1, 2, 3, 4, 5, 6, 7. I'm not going to go all the way through this because I did it. I got 15 readings over this period below 15,000. I got, I think I got only 8 in average. It might be an 18. I think it's an 18, and this is a 16 above. Maybe what I should be doing is bumping this up a little bit, because I don't mind having more readings in low volumes, especially on a Monday in the financial instrument futures. You're normally going to get lower volume than the rest of the week. So why are we going to? How are we going to use these? Well, I can't remember if I gave this to you or not, but there is a worksheet that I use. We go over when I'm teaching this in depth. What we do is we write down the price change, we write down the volume, we write down the open interest change, and then we take the general rule and we work it backwards, trying to determine what the direction is of the major price trend. And you usually should go back about 5 trading sessions. I'm going to go through this with you because I think it's important to your education. This is a very difficult time because of the expiration of the September contract. But look, Monday, that was September 13th. The December DX was down, 83 full price points. Volume was 21 5. Is that high, average, or low? And what does it mean? Okay, well, if we compare 21.5 to this range that we have, and that's right in the middle of the range. So that is average volume. What do we do with average volume? We don't do anything with it. You don't try to force the issue. See, we're trying to come to a conclusion. Who was the driving force? Was it the bulls or the bears? And if the volume is average, we don't force the issue. And if the price change was insignificant, and just a few ticks, you don't try to force the issue either. Because if the price changed, $20, $50, or something like that, is that going to make one side or the other say, oh my gosh, look at all this windfall gain I got, how am I going to spend my money? Or is the loser going to say, oh my gosh, I'm getting killed? No, so you don't force it on a change that's not big. Okay, but price down, open interest up. Okay, price went down, open interest expanded. According to this rule, what does that say should be the direction of the major price trend? See, whenever you see a positive change in open interest, you go to this sign and say that must be the direction of the major price trend. So that should be a bear. That's a bearish interaction between price change and open interest. The bears were in control. They were adding to their positions on the way down. They were the smart money because that's the direction the market was going that day. Here's the problem we have. Tuesday, well, we dropped about the same magnitude. The volume was 32,000. 32,000 high, average, or low? Well, according to 22.5, it's high. Price down on high volume. Is that bullish or bearish? Okay, it's bearish. Now, here's the problem. If you looked at the open interest figures only when they came out, it would show you the total open interest was down 4,500 contracts. This is something you only have to do when the quarterly expiration comes around. There were 6,638 contracts open in the expired December contract that the exchange took off, closed it out. So in this case, you have to look below the surface and see what happened in the next popular month, which is the December. The December open interest actually went up by 2,138. So I think this positive change in the December is more important. It shows what traders were doing that day rather than looking at the 4,500. So if you've got price down, open interest up, is that bullish or bearish? Were you looking at this plus? Well, it's the same thing as the day before. That's bearish. Okay, now Wednesday was a rally. Now, I was a little surprised at how high the volume was, but the volume was high. So a high volume on a price up day, is that bullish or bearish? That's bullish. Okay, and what did the open interest do? It expanded on the price up day. That's also bullish. I didn't want to go back any further because we've got some other charts we want to look at. But this is the type of thing you do. You want to go back about 5 trading sessions, and then what I do is add up the bullish and the bearish readings. We'll look at 1, 2, 3 bears and two bullish readings. Now that's not overwhelming, but over that 3-day period, this market is leaning towards the downside. And so every day you know what your directional view is, and you know what you want to see in the internal statistics. If you don't see them, then you start shifting back and forth from foot to foot. You start looking around for that truck that's about ready to hit you. If you get what you want, then you know, hey, I want to try to stay with my position because I'm in the direction of the major price trend. So I know I went over this pretty quickly, but if you followed what I was going through here, you're going to be ahead of 80% of all traders or dealers worldwide because they just don't pay attention to these internal statistics like they should. Okay, now let's go back and there was something else here I might need to talk about. It says, well, what if the contract's cash settled? Is there a trend component of open interest increase? This used to drive me crazy when the exchanges first started listing contracts that were cash settled. And I noticed at first with the Euro-dollar time deposit future that open interest would go up no matter what price we're doing. We just keep going up every single day. Keep going up. Well, I don't imagine ICE will mind if we sneak a look. We're gonna look at the DX open interest, but the Russell 2000 E-mini, this goes back several expirations. And this is always total open interest. You see what happens at the expiration? That nearby contract, when it comes off, causes the total to drop like a rock, and then look what happens. So what you need to do with a contract like this, if you're interested in the Russell, you have to trend the open interest increase. You go back the last 4 expirations, you find this slope, and I mean I'll just make a guess. I mean, what if that's 1,000 contracts, just to put a number on it, contracts per trading session. This is the trend component. If you see that the price on the E-mini Russell was up and the change in open interest was plus 500 contracts, and all you understand is that general rule, you say, oh look, price up, open interest up, that's bullish. Is this actually a bullish statistic, plus 500? No, not compared to the plus 1,000. It's like a minus 500. It's less than the trend component of open interest increase. So you have to be careful with this in the cash settled futures contracts. Well, I'm supposed to be talking about the dollar index. Let me show you what's been going on in the dollar index. This is this total open interest nearest to expire future. What happens just before the expiration? Here's in March. Here's June. Here's this little one right now. There tends to be a bump to the upside just before expiration, and then it drops off. A lot of the guys are putting their positions on in the next month, and who knows why they're letting the exchange close out their nearby contracts. So that's an idiosyncrasy. I obviously do not see a trend component of open interest increase unless we want to put in a negative. And I know the exchange doesn't want to talk about that. It's very surprising to me to see that. What I expect is going to happen now, because the dollar has been getting so much publicity lately, is the open interest start to increase in general. But I don't think right now we have to worry about a trend component of open interest increase. There was obviously a large increase on both sides here just a few weeks ago. And if you want to remember one word, remember the word fuel. Open interest equals fuel. It's fuel to sustain a price move. The concept is one of a fire. If you take the fuel away from a fire, the fire's going to stop. If you take the fuel away from a price trend, the price trend is going to stop. So you always like to see the open interest increasing, because think about it. Future trading is a zero-sum game. For every dollar in, there's a dollar out. And the clearinghouse is the world's scraping a little off. But look, you got to have a loser in there, right? And you want to know what the losers are up to, and you want to see that the losers are throwing more money at the market. And if open interest expands, if you know that the losers don't understand what's going on, and they're throwing more money at it. Well, what have I been doing lately in preparing for this presentation? It's like I do with anything I'm trading. I pounce on the statistics as soon as they come out. Now you go to that homepage on ICE, and then they've got this really nice thing called a report center, and there's a drop down of preliminary open interest, estimated volume, end of day, and there's one other one that I've been looking at. Right now, I'm going to just show you what the end of the day report looks like, because you don't have to wait for the end of the day for the previous day. You can keep hitting on this until the final volume open interest finally show up. So, for example, this morning, which is obviously the 16th, I put in September 15th, and you don't really have to worry about the date. The default is always the previous day. And you're going to make sure that you select the ICE US futures, and then the daily market report ICE US futures. When you plug that in, you plug these three in, then the product drop down will come up. And if you don't want to just get inundated with a whole bunch of stuff. Just pick dollar index. DX, electronic, is always comes up, and you click submit. Okay? So I shouldn't have to teach you where to get all of this. It's all there, and then the final, when it came out this morning, and I suppose I could, I don't have it written down right now, but when would you guess that the final would be out? Around 8:30 Chicago time?
8:30?
8:30 Chicago time. I printed up the printer-friendly version. There's more going out here to the right, but you don't need to, you're not going to pay attention to the contract highs or lows. It's going to give you, obviously, for the previous day, the high, the low, the close, and the settlement price. Now, this is maybe a question that I would ask, but with electronic dealing, you know, whatever the last trade is would be the close, but that's not where the exchange settles. And in the old days, they used to settle those back months so that they're in line with where we should reasonably be trading based upon a spread or basis consideration. But I noticed, and so I'm going to ask the question myself: who sets this settlement price, and how in relation to the close? See, the close, there's an asterisk down here. If you look down and you read what the asterisk says, is, you know, the final trade might not be exactly where the settlement price is going to be. Do we have an easy answer?
It's based on, if it's a liquid contract, it's based on the last minute of trading. So we do a weighted average, and that's what our settlement price is. But if it's like a spread or a farther out month, we go off of where the spreads were trading, or we go to the cash market and say, where would a 5-month or 6-month equivalent price be?
Right. One of the things that I did in preparing for this, and I always like to do this, I go, here's the, well, I started this one. There's a set contract, the D's contract, the March, the June, and here was the spot price. I wanted to see what the pricing looked like, you know, as you go out into the future, and I like to see what this, you know, differential is. The spread, we actually, there's a name for it. Why don't I ask you this? What do they call the difference between spot and the first future? That's the basis. Yeah, so this is the basis in here, and that's what keeps the futures in the spot, well, it keeps the futures honest with respect to the spot. And then you've got a spread and a spread and a spread. And so if the back months aren't traded, you can see that some of the open interest in the SEP 2011 was 0, but they still have a settlement price for it. They'll settle it based upon, you know, where the spread differential would logically be. So anyway, here's what you get. The numbers you want are these numbers here, not the individual contract months. Now, it turns out that there wasn't any volume in any of the other months except December, but I want to get you used to always looking at this figure. So no matter, you know, you're trading cocoa or orange juice or something else, you don't want to look only at the individual contract month, because otherwise your plot of open interest is going to start off at 0, go to a high, and come back down to 0 again when the contract expires. And you can't use that general rule. So you want to look at the sum of all of the futures contracts that are traded out there. You take all of these, you add them together, and here's your open interest. Pay attention to. Okay, now if you have questions or problems, you know, call up somebody at the exchange and say, hey, I don't understand this, but do some homework for a while, you know, and get those statistics. Okay, how are we doing? Okay.
Yeah.
Then what I want to do is, before I look at support, and actually this will take 2 minutes to look at support and resistance, and then we'll look at the hourly chart, because this is fun. I think I put this in your slides. To find support on a chart, you go down and look back to the left until you bump up against a former price high. This is the definition of support. To find overhead resistance on the chart, let's say you're in here someplace, and the market's rallying, you look back and to the left and up until you bump up against a former price low. These are the most classic definitions of support and resistance. You could make an entire trading strategy just based upon support and resistance only. Because you as a trader, you have to know when you want to enter a position, or if you're bearish, you want to enter it just on a rally just below the closest overhead resistance. If you're a bull, you want to buy a dip to just above the closest underlying support, and you want to put your protective order to cut. You always have to know when you're going to get out. That's actually more important, knowing when to get out than where to get in. And as soon as you get in, you got to know where you're going to get out, because to be a successful trader, you've got to take a lot of losses, and they've got to be manageable losses. They can't be a knockout punch. Okay, so remember what the daily chart looked like. The daily chart was bearish. We had inside range day. It might try to rally today. I gave you a chart early on. It's probably in your handout. This is the hourly chart, the early. This is as of 8:30 this morning. This should be in your handout. This line right here on the hourly chart is the neckline of the head and shoulders top that we looked at the daily chart. Remember, you can't see it. You can't see the height over here and moving it over. Well, we've got a big downside measuring objective. Here's where it broke the neckline to the downside. You see what kind of pattern we have on the hourly chart? 1, 2, 3, 4. Now, I admit we went awfully far into the apex of the triangle. It's a little suspect going that far into it. But a triangle formation is supposed to be a continuation pattern with 75% likelihood. Therefore, if a market's going down and you find a triangle, this is where reversal point 1 is going to be located, at a low. If the market's going up and a triangle forms, this is where reversal point 1 is going to be as a high. If you remember that, you'll avoid a lot of problems, and there's always going to be 2, 3, 4. It takes 4 reversals with a minor price trend. Well, it's not surprising we got a triangle here on the hourly chart, because the daily chart is already bearish. So this is a bearish continuation pattern. So what are we supposed to do? We're supposed to always go to reversal point 2 in the triangle, no matter whether it's in a bull market or a bear market, and we go to the opposite boundary line. And you can see what I did is I moved my cursor over on the chart to right here, and that was 81.434. If I subtracted these two distances correctly, it's 0.556. We're going to take that distance and we're going to subtract it from where the neckline, where the lower boundary line of the triangle was broken. And when I make that subtraction, I get a downside measuring objective to 81.15 and a half. So look, we've got a daily chart that's got an active pattern that's bearish. We drop down an hourly chart, we've got a pattern that's bearish. So obviously, as a short-term trader, which I think most of you are in this room, you want to have a bias of being on the bear side. Well, remember, we're not finished yet, because remember, you got to decide when you're going to cut, when you're going to exit. Well, this was as of 8:30 this morning. I'm going to show you a chart as of about 1:30 this afternoon. It's going to be exactly the same chart, but I'm going to have a couple more bars on it. What we did is we came down. We made a lower low for the day, but we did not get to the triangle objective yet. So what I did is I extended this upper boundary line of the triangle. The triangle is going to be valid as long as we don't get a rally that comes back up and eats into the triangle and goes through this opposite boundary line. So if you're a bear, your protective buy, stop, loss order is sliding down above that line. Now that's good news. You never move a stop further away. It's against all trading rules. You only tighten your stops. And I have that line coming across at approximately, if I find my notes, I think it was 81.80. Yeah, see this 81.80? Well, if you wanted to also make sure that you kept setting lower and lower lows, you really don't want this 81.87 to be taken out to the upside. And in theory, because we made a lower low here, you don't even want to see 81.67 and a half. So you also don't want to turn a winner into a loser. So if you were short already, and you could have your stop just above 81.67 and a half, and that's in break-even territory, then you can just fold your arms and say, hey, let the market tell me what it wants to do. I mean, I'm in control. See, if you're a day trader only, you might be able to scalp it from the short side, but the bigger profit is going to be, you know, if you have to trade smaller, fine, but hold the position, the bigger profits is going to be down towards the triangle objective and then to the head and shoulders top objective. So this is a real interesting situation. If I can, I don't know where I put the summary. See the monthly chart, big coil formation, something huge is going to happen in dollar index. Start doing your homework now so you're ready for it. The weekly chart, not much going on. Daily chart's bearish. The hourly chart is bearish. You know where to get the statistics. You're going to go to the site tomorrow and look at it because we were trading down today. If we close down today, you'd like to see high volume above 22.5, and you'd like to see a positive change in open interest. My guess is just because the second contract went off the board, the open interest probably is going to bounce back. Anyway, it'll probably be up. And nothing was moving around very much until just right when I left. And so, you know, it might wind up being lower volume than you'd like to see. But at least if you're a bear, you'd like to see total volume in the DX future above 22,500. And that estimate, which is a good estimate, is going to come out before the open interest figures are going to come out. And you just keep hitting on the daily, end of day. You know, for today, you do it tomorrow morning, and you'll see when the open interest will pop up. And if you want to be going and do an experiment and write down what the estimated open interest was, and then compare it to the volume every single day to give yourself some confidence that you can use the preliminary, then do it.